I have a great guest here in the studio with me talking about the multifamily outlook. Daniel is a partner and senior economist with Elliott D, Pollack Company. He has a wide-range knowledge of economic and fiscal impact models relating to residential, commercial, and mixed land uses. Daniel, I'm going to bring you in, and we're going to have some fun talking about what's exciting around data for multifamily. Daniel, welcome in.
Thank you.
Good to be here.
Yeah. Thank you for having me.
You're in Scottsdale as well. We opened up with, in our earlier discussions about the hybrid model. We'll get to that a little later because people are wondering, how people are living and working and where they're working and migrating to what cities and all those things. I know you guys track all of that. Can you tell me a little bit about, for those that are watching, who you are, what you're working on, how you're helping, and start there?
Sure. Name is Danny Court. I'm an economist with Elliott D, Pollack Company, and our group is a group of economists, and we focus on economic forecasting and also how that plays into real estate. So our focus is really on real estate, but we do get involved with government, with planning, forecasting, revenues, and all sorts of things like that. So in terms of multifamily, we're typically on the planning and development side. So looking at sites, finding the right site, and then also trying to help navigate through any sort of regulatory or political issue, which could be rezoning or something like that. So we work with zoning attorneys on that side, but we're there as objective third-party economists to study the market and provide data to either the developer or a municipality or government looking to consider multifamily for a specific real estate site.
Yeah, things are moving fast too. That data, not everybody. Sometimes people try and do these things on their own. And as the top of the show, I was talking about having experts and these types of things. What are you seeing right now, I guess, in the national economy? What are the things you're tracking? What are you seeing?
Yeah, we track a whole lot of data and keep it in a database. And right now we're seeing the economy is recovering really well. The biggest reason for that is vaccinations, too. 155 million Americans are now vaccinated, and that's helping the economy open up. Those industries that were hit hardest for COVID are the ones benefiting from the vaccination effort. Service industry, hospitality, tourism. Those types of industries that got hit the hardest are now able to try to return because of the recovery and the vaccination effort. So we're seeing a lot of pent-up demand, a lot of spending that was, there were still lots of people that kept their jobs and continued to make income, but couldn't spend it and couldn't go on vacation. And now we're seeing that sort of come back. And so that's a really good sign. We're seeing really high GDP forecasts. For the last decade, 2010 to 2020, average GDP was 2.3%. The forecast for 2021 is 6.3%, and for 2022 it's 4.3%. So really high demand, really good outlook for the national economy.
So 2021 and 2022 look better than even the 2.3 GDP growth.
Yeah, absolutely, and it's again that pent-up demand. We didn't have a real recession. It was a recession. We lost a lot of jobs, but this was not because of the economy. It was a government-induced shutdown for COVID-related pandemic reasons. So the economy was in really good shape in the early part of 2020 and had to forcibly shut down. And so again, you had those dynamics, no imbalances in the economy going into it, and now everyone's just sort of waiting until they can fully recover and recover all those jobs. So lots of pent-up demand, lots of money waiting to be deployed.
For investors and what they care about, how do you know when the economy is truly in good shape?
Yeah, besides a gut feel.
Yeah.
Well, I think it's this. I think it is looking at lots of different data sources, objective data sources, not, don't look for any sort of bias or anything like that. There are a lot of good government sources. The Fed is one to watch. They've got a lot of good economists looking at that. They're watching inflation. They're trying to keep the economy running on all cylinders. There's lots of consensus forecasts available at people's disposal to look at it. And back to multifamily, it's real estate, so it's local market, which is really important. So while one area of the country might be doing really well, that doesn't mean that everyone is good to go. You really need to have that local review as well.
Yeah, and there's pockets even within those local markets that even strong operators can even push through even unfavorable conditions. And I think the operators appreciate all that. And we're not trying to do any. I mentioned at the top, we don't do predictions and things like that. And I'm not going to put you on the spot and roll tape from 2 years ago and that kind of stuff. Sure. But what is the inflation conversation? What should we be thinking about that? And how does that impact apartment investors?
It's certainly a concern. The latest short-term inflation, figures, exceeded 5%. It's, some of the highest numbers we've seen in a while. Again, there's optimism for that's temporary situation, that it'll subside. That's sort of the outlook we're taking, but that has been the one indicator worth watching, continue to watch, because it does have an impact on lots of different sectors, including interest rates. So it's something to watch, and it's probably the indicator to watch in terms of downside risk, whereas all the other indicators for the economy we're seeing are extremely positive.
Aside from being engaged as a client, because I'm sure you're keeping your clients up to speed on all these things, how do we track that inflation number? I mean, where do we go for that, and where's the best?
It's a publicly available number. If you Google CPI, that'll get you probably where you want to go, or again back to the Fed and the publications that they have. But it's a regularly published number on inflation. There are different ways to track that. Sometimes there's an overall inflation that adds some more volatile products in there, and then sometimes they'll strip that out and say here's base inflation and things like that. But yeah, certainly it's a publicly available figure that's published regularly.
Yeah. Okay. Great. So talking about the national economy and really the more sort of broader range of things here in the States, how do we know when we're recovering, I guess?
Jobs is a really good place to start. Again, we sort of had this artificial recession, but there were actual jobs lost. So watching those job numbers, we had an excellent June jobs report out of the federal government. So really, really positive there. And again, that for us, that ties back to the vaccination effort and the ability for folks who want to work to be able to come back to work. But that's a really great indicator is jobs. The unemployment rate is going to be a little bit misleading. When people stop looking for jobs, they actually are removed from the unemployment rate. And so you see a lot of jobs being created, but then the unemployment rate sort of stays the same. You're like, why is that sticking up so high? It's because more people are looking for work, and so they're added back into the unemployment rate. So how do
they track that? How do they know when they're looking for work, I guess?
It's a survey.
Okay.
So they survey workers. Are you actively looking for work? Are you able to find work? Have you been able to find work in the last 6 weeks? Questions like that. So when someone that is in the age group that could be working and wants to be working but doesn't have a job, they are considered unemployed. When they stop looking, they're not in the labor force. And so you'll see numbers saying, hey, the labor force is really high. That means people have entered looking for jobs. And so as this continues, the positive trend of job creation and job growth occurs, you should see that unemployment rate start to drop as well, because now we've got everyone wants a job and now can get a job, and then that sort of goes in there. But in a recovery, that unemployment rate is typically like a sticky number that people might be confused about, but it's actually a positive. As long as jobs are growing, that's the positive indicator. Yeah,
and I know jobs being a major factor around how operators shape their business in terms of what markets to go to and how to drive income growth. What are you seeing anything changing in the idea of what a job is in America? global hybrid. We've companies and where they're locating. I know you do some office stuff too. So when you talked about CPI, I'm like, okay, these bumps and those deals are based off of some of those.
Yeah, there are certain real estate sectors that are in flux. Retail being one of them, brick and mortar retail versus online, and then the second is this office. This physical office space. How much do you need? How much space do you need for each of your employees? It was trending really far down. Like the rule of thumb used to be 250 square feet per employee. Private offices, things like that. Then it really started trending down toward closer to 115 square feet per employee. So that's an open office concept.
And now that square footage is in some cases in these apartments.
That's right. That's right. So that's what we're wondering about is this pendulum has swung to go ahead if you got an internet connection and we've got our database in the cloud or our files in the cloud, you can fully work at home. We've now come to understand that technology has caught up. A Zoom meeting can be can take the place of a physical meeting. It can also take the place of traveling. Business travel took a really big hit. Do you actually need to travel to that physical place to have that meeting, or can you do it over Zoom? And what kind of cost that does? But yes, the dynamic of working from home, what does that do for company culture? Is the pendulum going to swing back toward we need some physical space? We saw that with state of Arizona government. They sent a lot of their employees home, and then they said, you're not really coming back, but we're going to provide sort of like a co-working model for you so that when we want to do trainings or things like that, there's a physical space for you, but we're going to share, and we've dropped our demand for office space by 40% by doing so. So is that a permanent shift or not? We believe that there is some permanent shift. Who knows how much it is, but just offering the option to an employee as almost a benefit. If you would like to work from home, skip a commute, live somewhere where our company is not located, but you can do your work and have access. It's an interesting concept.
Yeah, and there's no point of reference for it either, right? There's no historical data to go off of.
No, this is new.
But you are tracking it. You track it now, and then as life moves forward, we have something to reference. I think when corporate culture, sort of the startup world introduced, with new investments and innovations, more younger in many cases, different generations building technologies like the Ubers and the Lyfts and things like that. They tested out a lot and got a lot of other corporations sort of follow their lead into creating more interesting work environments and open office. And then there's data like, did that work? Like, was it more distracting than fun? It seems like, but maybe this pendulum swings. It's like, oh, this is great. And then it's like, oh man, I'm fatigued. It's like,
that's right.
I'm tired of hearing Johnny over there, But it'll be interesting to track this too as well. I also think, do you guys look at, and this is really in the weeds, but do you look at data around the efficiencies that a company would, basically they're offsetting in many cases, their 250 square feet per employee, those costs to, get people to the office to have meetings and such into people's homes. I know the employees haven't figured it out yet. Like, hey,
where should we?
Am I going to be charging them rent? Or But is that conversation happening in corporations, or is it data in terms of are we going to get lift from more investment in things because of that savings?
I would say that's too early to tell, or maybe above, outside of the scope of what we're actually doing. But it would be an interesting discussion to have as far as because what I would say is, there is overall, there's a labor shortage. There are, employers are looking for quality employees. And so maybe the innovation is that a company thinks outside the box and says, we're actually going to subsidize part of that rent that's going to be your home office, or we're going to provide you, amazingly fast internet access, or some sort of benefit that benefits their personal life because they're sort of carving out a bit of their personal space to work for that person. So, I think initially it was just it's all cost savings for a company. If I don't have to pay for travel, I don't have to pay for the office space. A lot of people are probably still sort of stuck in we operate under 3 or 5 year office leases, so you may not have been able to take advantage of. You may have just had empty office space.
Right.
That was our situation. Was we just had a lot of empty office space that we continued to pay for because we had the ability to. So could they take advantage of reducing their office space need and having it at home? And then what do the employees want? I think that's another piece of information that ought to be had, because I'm sure personal preference, it goes across the spectrum.
Sure.
I'm sure there are people that have already tried out work from home from a previous job or something, and just
re-entry is going to be tough.
They want to be in their company. They want to be in the company. They want to be with their coworkers. So lots of different preferences.
Yeah, it's just two sides of it. I do a lot of leadership stuff, so I recognize the power of in person and meetings and things like that. But also, here we are, we're broadcasting to thousands of people all over the world, and that is efficient, in the way to get the content out there. And I imagine it also depends on the type of work that's being done. Obviously, the apartment industry has early figured out that to be competitive in early days, before even the internet stuff, is they would, and still do, compensate employees that live on site with, in many cases, sometimes a free apartment, right? And so you're working and you're living in the same sort of environment. Now the whole world just entered this, and you mentioned to me, like, it's great, but I now live, what was it? I live where I work or something, it's.
Yeah, exactly.
So it changes the perspective. So let's get back to the investment conversation around what the indicators. I guess if we were just to quickly say, what would be the major key indicators that we should be tracking? You mentioned CPI, obviously the inflation number at the Fed level. What should they, just quickly, what would be the key indicators that you should track in order to know where we are in the economy?
Yeah, we discussed employment growth, which is really important, and then population growth. And this goes back to the local market issue, is that, we can show national statistics, but if you're making an apartment decision and an investment decision in a local market, it doesn't necessarily extrapolate to all the different local markets. So certainly, as you're honing in, looking at the broader economic indicators and then honing in on the markets that would be the most advantageous for multifamily investment.
And we talked about Phoenix a lot, even yesterday. Talk to me about what you're seeing there.
It's one of the hottest real estate markets that we've experienced, and it feels like this exuberance of 2005, when we were actually in a housing bubble, and there were so much speculative development going on. There were more houses than people coming here, and it wasn't, in fact, a bubble that was oversupplied and had this glut of supply that we had to work through over the next decade. That is not happening. We are so undersupplied. Builders are not keeping up with demand, and we're seeing prices just skyrocket, just a continual march upward. We're seeing 30% growth in single-family home prices. We're seeing really strong growth in multifamily rent, really low vacancy. It's just, all the dynamics point toward just continued undersupply, and which really affects those prices, and it does attract development, but we need more of it.
Yeah, I would imagine what that message is getting out there, even to current renters. Maybe they're staying in place and taking those. We talked about rent bumps happening yesterday without even the improvements that were expected in the pro formas. And I think the public understands, like, limited supply. They're staying in place in many cases.
Yeah, can you? I
don't want to go out in the market
if you don't have confidence that you're going to be able to find another place because of the competition is so high. Yeah.
Yeah, absolutely. So in terms of those sort of spike, it's happening on the single family house, also the rent growth. Are you tracking the sort of affordability metrics?
Certainly, and Phoenix has always been known as a really affordable place to live, and that's
in comparison,
in
right,
comparison to other markets,
right,
to the coasts, things like that. We are losing ground on that because of those price increases. Still relatively affordable, but it does. That's why we look at both single family and multifamily. In terms of multifamily, you got to know what's going on. You know, these are the housing options for everyone that lives here. And I think we have a slide on income and affordability.
Yeah, let's bring that up, guys. That's the population slide here, or is it the other?
Yeah, this slide here.
Yeah, here we go.
So this is the United States. So again, looking at local markets, this type of demographic and income data is available at all levels of geography, and these are something you should be looking at. But again, back to overall trends, and giving Phoenix for an example, the median home price was $350,000 just 1 year ago. It's now $400,000. So a 30% rise in prices. Before, if I made $65,000, I could afford that house. This year, I would have to make $75,000. And if interest rates start to rise, the mortgage interest rate rises, I'm now priced out.
And everything else I'm buying is.
And everything else is getting more expensive, and I need to make a down payment on that.
Right.
And so here you have, these are all the groups of residents in the United States at different income levels. Well, if I was at 60 to 65 and I was a potential home buyer at that point last year, there's 4.5 million people that now are priced out. So what's their housing option? On the flip side, if I'm a multifamily investor, would I love to have a renter making $65,000? I think you could, create a pro forma around that.
Yeah.
And if housing is not an option for them in that market now, they're going to now possibly be looking at rent if you have a housing solution for them that's affordable to them.
Sure.
So those are sort of the dynamics that we're watching on the affordability side. Is at what income, how many people are there at each income level? Can they afford these different housing options? If single family housing is no longer an option for them because of these price increases, they may now be looking at the rental market. And is there a product that is appealing to them in the rental market? If they were initially considering going into buying a home, what would appeal to them in a rental market, because that's now the affordable option for them.
Yeah, that's powerful. So is that what you're helping with developers? I mean, before they go in and take that development risk, are you helping them through that data?
It depends on what they need, but yes, we're typically looking at the supply and demand dynamics. So, here's your site. Here are the people surrounding your site. Here's the likely pool of your tenants going forward. Here are the growth prospects in this particular market area. Here's how much they might make. Here's the percentage of likely renters. And so the dynamics around that. And then what else is in the pipeline? What's in the pipeline for single family in your area? What's in the pipeline for multifamily? And what kind of products are they coming up with? We give recommendations on unit mix. What do tenants want? And then what do we think is the achievable rent at those different units?
Yeah, smart. And I think about development. We were talking yesterday about cap rates or B properties trading for higher than even A properties. There's a lot of capital chasing B properties, and that number could change at any time. But in terms of development, and even John talked about yesterday about when you're going into a marketplace looking at due diligence beyond just these numbers. Who is city council? What is planning?
Yes.
Tell me about that, because I know in order to change, you need the data to support the things that you want to get influenced, right? Talking about what you're doing to help work through that process and even development.
Yeah, I mean, the perfect site could be ruined by just an anti-apartment sentiment in that particular city.
Right. Not
town.
always based on data, based on their presuppositions about what
Exactly.
an apartment is.
Exactly. There might just be a predisposed stigma about apartments of something they've heard at some point in time. I think data can help alleviate that to some point, or at least challenge the assumptions.
Like even
let them consider
crime
something.
data.
Yes.
So tell me, like, what would that be?
A classic example is, crime is reported at the property address level.
And I say this because that's when apartments make the news, and onto helicopter circling and telling the world like problems are happening here.
Right here, yeah. Nobody's considering the fact that,
and maybe that's influences the city. I mean, that's their vision or image of.
It could be, yeah. It could be a number of factors, but what we saw in the data was that crime was being reported at a property address level. Mm-hmm. And so there was no consideration that 1,200 people live at this one address,
right,
or 4 people live at this single-family house address. So when you actually normalize it for population, there was less crime in the apartment communities than there were just generally. Right. And so it's just another place where data can come in and just try to challenge that assumption. I know you've heard this, and maybe it sounds right to you that just for some reason criminals like to live in an apartment. Sure. No, it's not the case, mm-hmm. And especially in this affordability issue is really coming to the forefront. Density is the key to private investment to help fix the affordability issue. Mm-hmm. If government is not going to subsidize that to create an affordability, density is the solution, and that's multifamily development. Mm-hmm. So it's a solution that's already there waiting for them that they just need to sort of get their heads around. There's also we help model the benefits of having more residents in your area. It's to the cities. The restaurants don't produce the sales tax by themselves. The stores don't produce the sales tax mm-hmm. by themselves. It takes people with their disposable income coming and spending.
So planning and they're favoring commercial retail.
If it's already commercially zoned, if you're dealing with an economic development department, good luck getting them to say we would love to get rid of this as commercial and give you a residential.
Well, let me challenge you with this. It's hard. We were talking yesterday about people looking for deals, and jokingly looking for 4-cap in Phoenix and off market and calling brokers, and they're like, yeah, well, it's not here type of thing, right? And so the investors are trying to. You're talking about more people moving here than there are places to move to, mm-hmm. rooftops, wherever they are, single family, multifamily. If the affordability conversation is hitting home with even markets in California, Seattle, everywhere that's impacting with like rent control conversations, things like that, but supply could potentially, give some relief.
Yeah.
And I know we're talking about technology and innovations, getting construction costs down, building. I mean, in overseas, they're building towers in days with technology. But what they're doing is they're using, building innovation management technologies that allow plans to be seen in 3D and work through an effective process. But when they get to planning, all these plans get flattened, and then the process slows down. And so there's a little bit of where the cities probably have to innovate. But technology is a solution there, and there are people investing in technologies that can help efficiencies. Because I know construction costs, putting together construction teams, availability of those teams, plus lumber and all that kind of stuff that's going all over the place. All of these things come down to why we have to charge what we charge, right? I guess right. To make it work. Otherwise, you can't make the investment. But having heard all that, as we move through the supply part of it, is rezoning an opportunity where maybe it's maybe some hurdles, some harder work, maybe challenging, as you probably already know. But if they work with maybe someone like you to get the data, they have a better chance of telling that story and maybe finding a deal otherwise they wouldn't be able to find?
Absolutely. And we've got great strategies for that. Great methodologies, I think, that are objective, and there's an unbiased approach that you can take. One is showing the need for multifamily. So there's that side of it. Hey, there's pent-up demand here. Hey, you're working on an employment corridor here. Where do you want those workers to live? You're trying to bring employment here. Where do you want those employees to live? Because the most reliable workforce is one that's close by. On the other side of it is you're preserving this land for retail. Well, let's look at that. How much retail demand is in this area? Is it already fulfilled? How much vacancy is there currently in already built buildings? And then how much other land do you have reserved for retail or commercial? Is there really that much demand for it? We look at e-commerce and the trends in e-commerce. COVID accelerated that. There was a spike in online sales, online spending. That's just going to continue. And now brick and mortar retail is being replaced by fulfillment centers and industrial product. So it's just changing. And it's not even a negative for these municipalities. They still get the sales tax. When I fill my cart at Amazon and check out, right, I pay my local city and state sales tax on it, and those governments get that money. So that money is still flowing into them. Let's balance that. Like, is your land use plan in balance with what the market is today? Are they, the era of the power center is effectively over. There's just, you can't plan on having these big community and retail centers every so many miles. It's just not happening anymore. And do you have struggling retail today? What do you think would help struggling retail? Consumers, spenders. That would be your residents. You need to make a place for those residents to come.
Yeah.
So those are the things that we do and we provide. Again, back to your point earlier in your introduction, on the legal side, a zoning attorney that knows the area, knows the council, is well known, knows this strategy, knows what to do, knows what to provide, because it really depends on what is the sentiment of that council or that planning commission? What do they want to see? Because we also provide economic impact figures. Hey, for every new resident, you get this much in sales tax, you get this much in property tax. A residential project brings in so much more property tax than an industrial project or a retail project. So there are things that you can just show them, like, you thought this way, you thought, employment is the best thing to bring in, but here's the impact of residential. Here's what they bring to the table. And did you consider that before? Yeah,
very powerful. What about secondary markets? You're talking about retail, where people live, and some investors are going to these secondary markets that benefited most, probably, as Tanner said yesterday, about or with the work from home crowd. But there's also harder to develop in some of those areas, access to teams, capital, or not capital, but the vendors in many cases to build and design these units. What are you seeing in terms of those markets? Because in many cases, to get a project off the ground, the rents have to be X, but in many cases, those markets, the home you could purchase, and in many cases, it's even at or lower than buying a home, or renting is more than the mortgage on a property that you would own. So it becomes a hurdle of, the down payment and all that stuff, qualifying. But are you seeing anything with those secondary markets?
That's where a localized market analysis would benefit someone greatly, because maybe they've seen the opportunity, maybe they're familiar with that secondary market that doesn't get a lot of attention, but is there a reason for that, or is it just because it's just one of those smaller markets that's probably has a little bit higher risk? If it's, if you have a smaller base of population that you're going to try to pull from, and like you said, if it's an affordable purchase market, if it's affordable single family home market, can you compete? Can you come in? But there are metrics. There are metrics of, if a community is just predominantly single-family homes, there are still renters there. They're renting those homes. Is that their preference? Would they love a community that has a lot of amenities to it? Like those cheaper single-family rental homes probably don't have a pool, whereas an apartment community could provide that, a fitness center, some of those amenities like that. Mm-hmm. So I think that goes back to that local market study. How much do these people make? What are the growth prospects? Mm-hmm. How many renters are out there? We're working in a community that has 0 apartments. They're getting their first apartment project is under construction in a community of over 50,000 people, no apartments. And the question was, can you fill an apartment when there's no apartment? It's like, how do you even study that? And especially on the affordable side, if you don't make enough money to afford that community, you've left the community. So how do you gauge could you bring people back into the community because they were priced out earlier, but now you're providing a product? Would those people come back? So there's lots of things that research can help inform on, I believe. And so I don't think there's a rule of thumb, but there's plenty of tools and due diligence that can be done to give you more confidence or to help you make a decision not to enter that market.
Right. And so you even mentioning this community of 50,000 with no apartments, and are you tracking the generational stuff, like what the customer of tomorrow expects? Because in the apartment, and you're talking about density, and also getting down the cost in terms of square footage, I would imagine at some point they're just outgrowing that. They may enjoy the amenities of the lifestyle of that, but they're outgrowing and they need more of a home. And that'll kind of lead into my next guest on building for rent and essentially single-family homes that are built for apartments, horizontal.
Yeah.
What are you seeing in terms of the customer expectations on the product? Do you track any of that too?
We do, and I think maybe that demographic slide that we had before,
let's pull that up. The demographic slide
might help with that. What we've seen in
this here,
yeah, what we've seen in surveys is that where there was sort of a buzz or a conversation of everyone's leaving the suburbs, they want an urban lifestyle, they want a walkable live, work, play community, and so that's apartments, that's inner city, dense urban type. It really isn't playing out in the surveys. The surveys that we're seeing is that the millennial population eventually does want that suburban sort of lifestyle. Maybe it's owning a home or at least living in a housing unit that reflects a little bit more space, a little bit of a yard. And what this chart here is showing is the next 10 years of demographics in the United States. And so the darker green is what's here today in terms of the population by age. And then that lighter green, as you see them bump up, that's the population shifted 10 years into the future. And so you see these different shifts. And then this black line here is the percentage of households with children. And so that was also a conversation is, the millennials or Gen Z, they're delaying marriage, they're delaying having children, which bodes really well for apartments, because if you don't need the house and the yard for the children, then you're totally fine being in an apartment. But the eventuality is that this population will get married and will have children and may prefer a single-family home or something like it. And so we're seeing a big jump in the next 10 years in that population coming. The other is the baby boomers. And what will baby boomers want in terms of their housing? Because we are seeing that shift as well. Their house, if they owned a house, is typically their largest financial asset. And so for a retirement solution, do you want to sell that asset and move into a rental community and there's your nest egg to live off of and go back into a rental community. So that's what we're watching, is what are the preferences of the baby boomers, because you see it's just a huge population shift over the next 10 years of compared to today, and what will be their housing preference, and also this the millennial and Gen Z sort of coming into forming a household, marriage, children years. What will they want? So, yeah, those are certainly some things to track.
Yeah, and that product preference point as they make that shift would be perhaps that build to rent.
Build to rent is it was interesting to see it come on, but it is certainly here to stay. It is a viable product. It's gonna be a part of the market going forward, and it's really interesting to see the different product types within build to rent also coming out. So there are, there's townhome projects that are all built to rent. There's some that you could drive into and you do not know that this is a build to rent community. It just looks like single family homes, 40-foot wide lots on yards, but they are all controlled and being rented, as a product type. So yeah, it is changing the market. And then back to the affordability issue is if I don't have to save for that down payment, which we just saw a recent article, applying.
But still enjoy the home that I want.
If you apply Americans' household savings rate, and then how much down payment you need to save to get to that, it was projecting 6 to 10 years to save up for that initial down payment.
The dollar's dropping rates.
Too. Yeah, and is housing prices it's a moving target if housing prices are continuing to rise,
right.
Versus at my income level, it's got to be a frustrating dynamic of I have enough income to afford a mortgage, but not enough to save for a down payment. Build to rent could be that solution where I don't need that down payment, but I can afford that mortgage and be in a 3-bedroom sort of detached home with a yard.
Danny, this has been refreshing, awesome. I know the viewers are enjoying this. We'll make it very easy for them to get in touch with you. I'm sure they'll have some questions and want to get some of that data around the projects they're working on. So I appreciate you coming in.
Absolutely.
And hopefully we'll have you back soon.
All right. Sounds good. Thank you.
Very good.